can compress. Awesome. Here we are, Jace. It is Tuesday, the 6th of December, 2022. And we are here today. This is our first video that we're doing together. And I'm really excited. I'm stoked for those that are following, those that are watching, to just, kind of embark on this journey with us. And I'm really looking forward to providing information and conveying value as best we can. Jace, I've known you for years, but I know everybody that's going to see this video probably doesn't know you, or maybe might know you through me working together. But could you just tell us a little bit about yourself, introduce yourself and what you do?
Yeah, hi. I'm Jace. I'm Josiah's friend, first and foremost. I've been a mortgage professional for a handful of years now. And more recently, over I'd say probably the last 12 to 18 months, I really refined that title. So I really come into my own as a professional, and I'm here to give you guys my insight on what's going on. So
Awesome.
appreciate the opportunity as well, Josiah.
Absolutely. And you know what, Jace, I'm so looking forward to this. I mean, listen, this is potentially something weekly we might be doing, market update, and really I'm looking forward to what 2023 has. And I just thank you for making time in your day today and in your schedule to help me record this and provide value to our clients, our friends, those in our sphere, and anybody who comes across this video and actually get something out of it.
1000%, man. I appreciate you too.
Awesome. Excellent, dude. Well, hey, listen, first things first, I may need to make sure I introduce myself. Hey, I am Josiah Sukso. I live and work in Rancho Cucamonga, California, but I service all of Southern California and licensed in all of California, of course, working on getting licensed outside of state. However, I am a real estate professional. I am not just a realtor. I am a consultant. I am an investor specialist and a master of my craft, constantly pursuing that. And I am here today with Jay Stray with New Home Team, and we are here to provide you not only a market update, but really just to share with you what's going on with interest rates right now, and what does that mean for our market currently, and what does that mean specifically for buyers and sellers moving into 2023, quarter one. And what I'm going to do now, Jace, is just kind of ask you what's happening right now with interest rates. I know that the Fed's just announced the conventional loan limits, and they projected what the FHA loan limits will be. Can you kind of speak to that and what that means?
Yeah, 1000%. So, as as most may have heard, interest rates are up right now, and it's kind of a shell shock, especially since we're coming out of the last 3 years where the rates had been historically low in lending history. So, but with that said, the Federal Reserve is actively raising interest rates on purpose, and what they're trying to do and accomplish is they're trying to combat inflation and economic inflation. And what inflation does is it raises the cost of goods that consumers purchase. Obviously, one would be the housing prices, and I'll delve into that in a little while as well, because inflation is not what's driving the prices of homes. But as they raise rates, what they're trying to accomplish is slowing down consumer confidence. So, and I'll take a Warren Buffett quote. What they're trying to do is have everyone run out of the market. And what I'll explain to you guys is why I particularly think that is a great time to walk into the market is while everyone's running out. So
Awesome. And you know what, you're absolutely right. And I appreciate that, Jace. I mean, what we've seen, guys, is over the past 2 to 3 years is just an insane market. I mean, I know we helped, dozens of clients get in with under 4% in interest rate, an all-time record low, historically speaking, in regards to interest rates in the United States. And that obviously has incredible benefits and low interest paid over the course of your loan. However, what did it do to our market? It increased demand tenfold. We had homes selling for 10 20% over list price, home values increasing exponentially year to year, 12, 18, 28% which is absolutely unheard of. And the national average should, in a healthy market, should be year-to-year increases, according to NAR, or the National Association of Realtors, should be between 4 and 6%. And so having an 18% increase in market, or in property values, isn't necessarily the healthiest market, right, Jace?
It,
So
yeah, it's definitely not. We will, and we have already really hit an affordability index. There's a couple outlining factors. There's very low employment rate, which means there's a ton of job out there. And on top of which, we have what's called a healthy inflationary rate. So anytime you hear like your parents talking about, oh, well, in the 80s, I bought my house for, $80,000 or $180,000, $150,000. So what a healthy inflationary rate is per year is about 2 to 2.5%. So you want some inflation in the market. And so over, from in a 22-year span, you're increasing the value of things 2.5% as a healthy factor. So there's, and then that compounds, obviously, right? So you want some inflation, and the days of buying $100,000 house or $150,000 house, they're really long gone, and that's by design. It's by economic design. So I hope that answers
no,
your question.
absolutely, absolutely. And I think where we're at right now, and what we've currently seen, and we'll kind of talk about this later, later in this video, but is right now, and I'm specifically speaking to the Inland Empire, but more so just Ranch Cucamonga, Fontana, Upland, Ontario, Rialto, these areas that are kind of around that like 210 freeway, 15, and the 10 freeway corridor. We've seen a decrease in property values of roughly 10 to about 12-13%. And I'll show you guys some of that information a little bit later. And that isn't a, sky is falling, scatter, you know what I mean, run for the hills. What it is kind of what you spoke to earlier, Jason, and it's a market correction. It's a much needed market correction. It's something that we need to do, and that has already happened. And I know, and that we have, you can read and you can hear. I mean, depends on who you listen to in the spectrum, or in the market. I mean, whether it's Grant Cardone, Patrick Bet David, or Dave Ramsey, or a dozen others, expecting or projecting somewhere around a 25% to 30% market correction. But with that being the case,
I don't think that's. I wouldn't say that there's a 25 to 35% market correction. I think those are clickbait numbers, and I'll explain. I think we're in a temporary market correction. One of the main factors on driving the price of goods is a supply and demand. So right now, with the Feds raising the rates, we have only addressed one leg of the horse, which is the demand. We have not addressed the supply, especially in Southern California, where we have a very low influx of properties as a supply being sold. I think in 2016, in a very close county to me, in Riverside County, in the last quarter of 2016, there was almost 15,000 homes sold. In the last quarter of last year, there was under 5,000. So we really have a supply issue, and not to mention that each year 30%, and on average over the last 3 or 4 years, 30% of the homes being sold are bought by investors. So those aren't going to be hitting the market anytime soon. So we're just continuously siphoning off inventory to entities that aren't going to be relisting. And so we really haven't addressed the supply issue. And so once rates drop again, because they inevitably will, once we hit a healthy inflationary rate, we're going to go back down to, to the 4s, potentially into the 3s again. And what the Fed's going to try to accomplish is going to get the train out of the station, where they're going to inject consumer confidence, like, hey, borrow money again. We're hitting all these great numbers. This is where we want to be. Let's get the ball rolling again. And then guess what? everyone's going to be flooding the market, driving prices up, competing, because the demand is just going to go through the roof, uh, and we never have corrected the supply. So, and that's why I think we are in a temporary market correction. And also just kind of backs like my theory is in now would be a great time to get into the market. You're not going to have the most favorable or desirable interest rate, but it can only get better. It can only get better from there because we will hit a healthy inflationary rate. And I stand by this statement that the Feds will reduce rates again, like because there is a rhyme and a reason why they're high right now. So,
Well, I mean, I couldn't plan it any better. What a great segue to our next point. And what we're going to be talking about next is why is right now the best time to buy in the past 5 years? I mean, just like Dave Ramsey said, and I know we've quoted him already once, and but he said specifically, if you can afford to buy, right now is the best time to buy in the potential foreseeable future in the next 5 years for sure. Right. And why is that, Jason? And just to speak to that, and I'll just kind of speak from my specific real estate perspective, right? My past 3 transactions specifically have all been transactions where the seller was motivated, the buyer was willing and able to afford the payment, right? And there were repairs negotiated, there were credits negotiated. Seller was willing to buy down the rate, and I hope you can speak to that as well, Jace. But willing to buy down the rate and help my buyer afford a much more affordable payment over the next 2 to 3 years. And this wasn't something that we were experiencing last year. Could you speak to that a little bit?
yeah, absolutely. So this time last year, we had buyers and borrowers fighting each other hand over fist. And then listing agents also playing off that, right? So I remember I had a conversation. It was one Monday morning in the middle of last year, in the height of things, where people were paying above appraised value. They were removing all contingencies, just totally taking away all of the protecting factors for themselves to at least compete to get an offer accepted. I remember it was one morning. We had an offer, me and an agent. We submitted it, and I decided to make a phone call, Monday morning phone call. And so I called this listing agent, and he answered the phone, very pretentious, and he almost seemed out of breath. And so I segued into more of a personal conversation with him. You all right, man? He's like, it's Monday morning. I've already taken 1,500 phone calls. What can I do for you? I was like, wow, okay. And then I proceeded to try to outline the strength of my borrowers. And he said, hey, listen. He said, how much can they pay over appraised value? And I was like, nothing. Because
Yeah.
I wanted to protect my buyer, my borrower more than anything. And he said, cool, well, you're not going to get your offer accepted. And then that was the end of the conversation. It was insane. So
And if I could speak to that, that's definitely something that we dealt with this past 2 years, this past year specifically. I mean, understanding it, it's very difficult for buyers, specifically first-time home buyers. And we know, according to NAR rates, I mean, 88% of your purchasers in this market, in any real market over the next years, with the largest buying population to ever hit the market, statistically speaking, being our generation, Jace, you know what I mean? Millennials, you know what I mean? And the generations that are subsequent. I mean, this is a very interesting time. And when I was sitting there negotiating, explaining to my clients over the past couple of years, hey, listen, guys, like, this is the appraised value and you're willing to pay X amount over. Why is that? And why that's okay, and why, I had to instruct them and give them the direction so that they understood. But not everybody can do that. Not everybody has that kind of those kind of liquid assets. And it was a very tough time. It was a very tough time not being able to leverage your inspections and not being able to negotiate for repairs, or taking on a house that needed way more work than you had anticipated. But you wanted to lock in that 2.5% rate. You wanted to make sure that you were the one, the one client, or I'm sorry, the one buyer that got the house. against the 25 other offers, you know what I mean? And it was definitely, it was challenging. It was challenging as an agent, that operates from a place of integrity. And it was really important that I communicated that to my buyers. And those that did obviously are in a really great place with a very affordable payment. And they can be in that home for the next 4 to 7 years and be absolutely comfortable knowing that the market, the cyclical nature of the market, their home will be valued and they'll be able to save all that money in regards to the interest paid. However, now we're in a different place. We're in a completely different place, Jace. And what you just mentioned, I think that understanding that the nature of the market has changed, it's switched, but it's better because now the pendulum has swung the other way. And I don't necessarily, I hesitate to use the word power because it does kind of create that binary, right? But
Use the power, man.
yeah, but the truth is, buyers have a lot more leverage that they can use, and they're able to negotiate terms, and sellers still need to sell, right? I mean, sellers still need to sell, people still need to buy homes. And so what I'd love to
100%, man.
touch on. Go ahead.
It just because I already know where you're going. So yeah, absolutely, man. The buyers now have a lot more advantages. And then there's even some niche products out there, or niche products, like a 2-1 buy down, a 3-2-1 buy down, where your rate is bought down by the seller temporarily. Now, obviously, that has to be negotiated, and depending on how much you want the house, like, do you really want to negotiate that, or do you want to negotiate maybe like a fixed rate buy down? Regardless, you would still need to be qualified for the property on the fully amortized percentage. So, for example, if we could lock you in today at like a 6.375, a 2-1 buy down, the first year it would be a 4.375, and then the following year it'd be about 5.375, and fully amortized on the third year at 6.375. You'd still need to make sure you're qualified for that property based off of the 6.375. And those are options to really soften the blow on the payment. But either way, your qualifying ratios are based off the 6.375. So guidelines are saying that you can technically afford that house regardless. I mean, obviously, budget wise, do you really want to be allocating that much of your income towards housing expense? More often it's going to say a no, but per guidelines, you in theory you could, with some proper budget allocation. Also, what you can negotiate now, as I'm seeing homes, and I'm sure you could attest to this, Josiah, is that we're seeing homes like, for example, let's say it's listed at 450. This time last year, in the years past, that 450 listing would end up selling for 500. Well, in this market, you have so much negotiation power. You can maybe even get that 450 listing for a 425 purchase price. In fact, you and I did a transaction a few months ago where we negotiated a purchase price that was below the actual value of the house. So our clients, our mutual clients, mine and Josiah, actually walked in to the home with equity, which is that's insane, right? Like we hit a home run on that one. So there is a lot of leveraging power right now, and it's just obviously due to the demand being so low, with everyone just walking out. Imagine everyone's strategy. Imagine how many people's same strategy is this. Oh, well, we're going to wait till the rates go down. I'm sure you are, along with millions of other people.
Yeah.
Right? So, and then at this stage of the game, like, how many people's strategies are like, hey, we're gonna eat shit on that rate for the next 18 months. So we're going to go in and buy. There's a very small, very select few of consumers and borrowers and people excited to purchase their homes are going to have that strategy. So, and then another issue that I'm really seeing that really solidifies mine and Josiah's analysis of the market is that conventional loan limits and FHA loan limits have just increased. So now, with 3.5% down in San Bernardino County, you could finance $644,000. So you could buy, almost a $700,000 house with 3.5% down. In years past, that would be what's called a jumbo loan, and you're minimum doing 10% down, and it gets better for you if you're putting 20% down. But now the HUD, the urban or the housing administration, they're raising these loan limits because they're forecasting what's to come. And that's once rates go back down, we are going to have a free for all.
So once again, Jace, you create the perfect segue into the next topic that we're going to talk about. And just to kind of reiterate, so what you were saying earlier in regards to the negotiation tactics that buyers are privy to now, and what's back on the market, these potential or options, different loan options, loan packages, but that 2-1 buy down. And I just want to clarify for our listeners, clarify for those that got this. So basically what it is you negotiate, and certain not concepts, but certain packages have to have the monies come from the seller. But let's just put it, and we'll just put it in basic numbers, right? If you had a home listed for 500,000 and it sat on the market for X amount of days, right now, I'll show you a little bit later, in the city of Rancho Cucamonga, average days on market are 53 days. Okay. So if you have a house and it wasn't priced correctly, or it sat there, but you're a seller and you need to sell this home, you need to liquidate these funds for whatever, you found the perfect replacement home, you're moving out of state, a new job, kids have moved out, you need to downsize, you got too much space, the operating cost of your home has gotten too expensive, all these different gamuts of reasons.
The myriad of different reasons why.
A myriad of different reasons, exactly. And so now you're sitting there, you have an offer that comes in like, hey, Mr. Seller, I am willing and able and can afford the $500,000 purchase price. However, what I'm asking you is, can you help me buy down my rate so that I can afford my payment and make it more comfortable for me over the next year to 2 years? And you come in as a buyer and you say, hey, listen, it's going to cost let's just put round numbers on it, $15,000 for me in interest in order to buy down that rate to a more affordable rate of 4.375, which brings your payment down X amount, that gives you that affordability that you need. And the seller's in a place where, hey, listen, instead of sitting on the market and losing even more potential money, I have a great qualified buyer, and I'm willing to give that out of my net profit to help them purchase and me sell so I can repurchase, or the myriad of options or reasons for that.
You could structure it all kinds of different ways, but now listing agents and sellers themselves, they're much more willing to listen. Like, hey, we need you to lower the purchase price by 20,000, 25,000. That's out the window. Like, well, can you give us $12,000 towards either a rate buy down, permanent rate buy down, closing costs? Like, let's negotiate. And that's where Josiah and having a really good realtor, that's the difference. That's why you want a really good realtor. So
that's something that we explain to our sellers and buyers alike. Like, hey, listen, that purchase price at 500,000 still respects your market that you're living in, right? You're not accepting some lowball offer. No, what you're doing is you're negotiating accordingly. It's a win-win for both sides. And your neighbors will appreciate you taking an offer at 500 with credits, as opposed to staying on the market and
price,
getting something at 450.
We sold it for 450. Like, what the heck? You're now your neighbors, your old neighbors. But they're like, what the heck, bro? But no, instead of doing that, and honestly, like, if you lower it to 450, but then their rates at like a 6.375, or even, dude, 4 weeks ago, we were in the sevens.
Yep.
Imagine you locked in at a 7.125 or 7.250. You have that rate. If you at a 500,000 purchase price, if they lower it to 450, you're probably still paying more than if they kept it at 500,000 and just gave you a buy down.
Yeah.
So,
and it's such a great option. And correct me if you could, just as we segue into the next part, but when that seller does allow that buy down, that money belongs to the buyer, correct? And it's held in a third part or in a specific extra escrow account that subsidizes their payment. And with the projected potential, rate corrections at the end of 2023, Q3, Q4, I know you're going to speak to that a little bit. That buyer can refinance, correct? If I'm not mistaken.
Absolutely. Yeah, you have to season your loans, 6 payments. So you have to make 6 payments on them. They have to be a seasoned loan in order to refinance. But yeah, let's say you get a 2-1 buy down, the seller contribution as a buy down. That buy down buys down the interest rate for the first year and the second year. But then, here in 12 months or 18 months, the rates go down. You could refinance.
And what
You
happens? What happens to that money? Like if there's residual money, let's say it is 20 grand,
So
right?
so it paid to the lender, man. So
Okay.
and the borrower does not get reimbursed. I've called a couple account reps because that's been a scenario that was asked of me, and I was like, hey, that makes sense. And so like, yeah, well, if they refinance within that time, like, yeah, like let's freaking get that that refund on whatever the cost of it is. But that's the cost of the lender doing business. They're essentially, what they're doing is they're charging all of the interest up front.
Mm-hmm.
So if you don't utilize the full 2 years or 3 years, it is what it is, and it goes to the house. So,
Gotcha. Understood. All right. Yeah.
but
'Cause
and
I know
that's
there's
where the lender is making their money. They're making it up front. So
Gotcha. So it does, I mean, it benefits the buyer regardless. And if it does, if not if, but when interest rates do correct themselves, I mean, they're still going to be saving money in the long run.
they're
So
still going to, yeah, because rates inevitably will go down back into the fours. I'm theorizing that they're going to be in the threes, the high threes for at least a small percentage of time, whether if that holds or not. Because like I said, once the Fed hits that desired inflationary rate, it's going to slow down the economy to a certain extent. There's going to be an opposite effect of like, hey, let's get this freaking train out of the station. Let's lower these rates to inject consumer confidence, and then slowly bring them to like a healthy level where they're managing everything. But yeah, that's we could definitely see a high 3% APRs, and those are beautiful. Those are great.
Gotcha. Well, hey, listen, let's get back. We're kind of into the new loan limits. All right. New loan limits, and I'll explain this to from a realtor's perspective. I mean, when I hear new loan limits at the end of the year and they've increased, I can't remember what the exact number or the exact percentage was, but somewhere around an additional 10%, if I'm not mistaken, specifically for FHA. But what does that mean? You know what I mean? And as a realtor, what I'm doing is I'm calling on my clients, those that, hey, listen, because of interest rates, their affordability, their buying power decreased, and interest rates went up, their buying power went down, which affected obviously their debt to income ratio, and they can only qualify for so much. Well, now loan limits have increased, allowing for that buying power, allowing for those people that were like, hey, listen, I can't afford 5% down conventional anymore, or what I mean, like, I want to buy this house in Fontana with at this price, or this house in Rancho at this price. However, FHA only allows me to purchase up to this amount, and I really want to get in here with FHA. And for those of you guys that aren't familiar with FHA, I mean, FHA loans for first-time home buyers, you guys, is 3.5% down. You
Yeah,
do
3.5%.
Yeah, you do not need
Sorry,
the
yeah,
6% conventional. That
nope.
is, we're myth busting today. You can get into a new home with as little, conventionally speaking, with as little as 3% down. But there are 3.5% down programs for first-time home buyers, which, I mean, listen, you guys, hey, it is not forever, but it gets your foot in, and it's not about getting you into the house of your dreams today. It's about getting you started. right? Getting you started in building that legacy, building that family legacy for you and your family, and creating those opportunities for your growth. And so can you just speak to that just a little bit? I know you have a couple slides you want to share. I think now would be the time. What's going on with loan limits? What's going on? What does that mean? And just kind of let us know. Riverside and obviously San Bernardino, Riverside County and LA County. I think you have some numbers on those too.
Yeah, absolutely. So in LA and Orange County, with an FHA 3.5% down, you could essentially buy a $1.1 million house. So with under $40,000 as a down payment, you can buy a $1.1 million house in LA and Orange County. And here, let me bring some of this stuff up
Are you able
here.
to share your screen, Jace?
Yeah,
All
yeah.
right,
Give me.
perfect. No, take your time. I mean, this is really exciting news. You know what I mean? With 3.5%, you guys. I mean, let's just look at the median sales price in the Inland Empire specifically is just around 500,000, right? So I want to take the number 500 because it's really easy to do percentages. I'm not a mathematician, but at least I learned a little bit in school. So at 500,000, 3% would be 3.5%, 17.5. That's $17,500 as a down payment for a home at 500,000. You guys, that's amazing. You know what I mean? That is absolutely astronomical. Oh, here we are. Thank you, Jace. I appreciate it. Go ahead.
Hey, give me a second here.
Yeah.
Here we go. So these are the loan limits, obviously, in San Bernardino and Riverside County for a single unit, for a single family residence, 644,000. So essentially, just under 700,000 you can buy with 3.5% down. In San Diego County for a single family residence, 977,000. So you're probably looking at roughly $1 million, just shy of $1 million dollar property as a purchase price. And in LA and Orange County, these are the big ones. Single family residence, one unit, 1.8, 1,089,000. So with your down payment, included, that's a $1.1 million house with 3.5% down, under 40 grand.
So just to clarify, Jace, what you're saying is, so FHA loan limits have increased to a point, and we'll just highlight that real quick in LA and Orange County. So if I live in LA and Orange County and I find a house that's 1.1 million or 1.9, right? 1.89.
So the 1.89 is the financing portion.
So I can
That's
put,
what you can finance. So after, you factor in your 3.5% down to that. So that's at 1.1.
wow.
Yeah.
Wow.
Yeah.
I mean, this is amazing, you guys. Like, this is such a tremendous opportunity for so many.
Yeah, and what are they telling you by doing this? They're telling you that the market correction that we are in right now is temporary. Like if they're increasing these loan limits, like they're foreseeing what's to unfold. So
and I mean, steadily, regardless of how you look at it and how you picture it, in the United States, since we have been tracking the numbers for the past 70 years, we have seen a trajectory that's upward. That's why when you speak of investing, you speak of net worth. What is your greatest return on investment? What is your greatest return is owning property, owning your own piece, owning your own home, and using that in the future, using that to leverage and creating. And obviously, Jace, you and I, we're here to help people do that, and that is a goal of ours. Leading with this information and doing our best to educate and empower our clients, our friends, and those that see this video. So do you happen to have the conventional loan limits as well?
yeah, absolutely. Let me get that out of here.
Man, I really like your background, Jace. Those are awesome. Are those all yours, or did you buy those
Yeah.
off Etsy?
No, these are all mine. I started collecting comic books when I was younger, and my mom held on to them. My mom, she has hoarder tendencies a bit, but I'm so thankful for it because I was like, "Hey, mom, do you still have those comic books I have?" And she's like, "Yeah." And so obviously, as an adult, like I'm really into Marvel, super into Marvel. And as a kid, I collected Marvel and DC. So I also have another stack up there that's all primarily DC. But I hung all my Marvel stuff up.
That's cool.
Let's see here, let's share
Super
this.
cool. Your background's way better than mine. That's why I blurred it. But hey, this is our first video recording together, so I'm really excited to see what the future holds for us.
Yeah, the future's, yeah, you're not always. So here is going to outline the conventional loan limits, and there's going to be two scenarios in this. Essentially, give me a second here. All right, so there's going to be a standard loan limits, and then there's high balance counties, which is like LA and Orange County, is going to be high, and so essentially the new loan limits for the high balance for conventional, it's matching that, but the new loan limits in like San Bernardino, Riverside County, it's going to be a bit higher. So where for single family residence, one unit, you could do 3% down on this. Is the maximum financing portion is 726,200. And obviously, if you're buying multiple units, it's different. But on conventional, as you buy multi units, you have to put 20% or 25% down. So the financing portion on, like, for example, 2 unit, 3 unit, 4 unit is actually going to be, your purchase price is going to be much higher than the 929,850 or 1,123,900, because you're keep in mind you're putting 25% down, and that's the financing portion of it.
Got it.
But but for a single family residence, primary residence, first time homeowner, you're locked in, man. So yeah, this is good.
That's amazing. These are huge. These are huge numbers, especially since we've seen the trajectory over the past couple of years where, home prices have increased, 18, 20% in certain areas. You know what I mean? So this really,
yeah, just in Rancho, in the northern aspect of Rancho Cucamonga, they got $900,000 house. You have $1 million houses up there too. But obviously keep in mind, like, we're much closer. We're much closer now. You could afford, for example, you could afford almost an $800,000 house with 3% down.
Can you explain a little bit real quick before we go past this, and go into a little bit of what's going on in the current market today? Can you explain just real quick for the listeners and those watching what an FHA is versus what a conventional loan is?
Absolutely. So your conventional loan, that was the first; those were the first types of loans that were being offered, and they're traded on the secondary market. So there's you could actually buy REITs, and you could buy loan products as an investor standpoint with the stock trade. That is a little bit over my head for the most part. I mean, I could kind of outline a bit of it, but I don't particularly invest in real estate on the market. But essentially, on conventional, the higher your FICO score, the more you're rewarded, right? So you have a higher FICO score, obviously above 700. You could go as low as 680, but you get to above 700, 720, 740, 760, 780. You're rewarded for that, one, in the interest rate, and then two, if you're putting under 20% down, in your monthly private mortgage insurance, right? So your mortgage insurance is what's paid. There's these pools of mortgage insurance that will cover, essentially, if you default on a rate, or if you default on a loan, they'll cover the banks, or in theory they're supposed to, right? And so the government came in, and because that's not necessarily like an equal housing opportunity, so the government came in and they designed an FHA loan that will help out people that have less than desirable credit. You could go as low as 580 on FHA, and it's variable, very affordable. The rates are typically lower, as much as a 0.5 point to 3/4 point than what conventional is offering. The only difference is the FHA is a government-backed loan, and the way that they do this is they have mortgage insurance and set mortgage insurance. So regardless if you have 800 FICO score or 580, your mortgage insurance is set based off of the purchase price of the property. Also with that, you have upfront mortgage insurance that's tacked onto the loan. So for example, like on a $400,000 purchase price, it's about $6,500 that's added on to your loan amount, right? And so you don't really see it, but it's added on. It's essentially taken out of your down payment, and it goes into these big mortgage insurance pools, along with your set monthly mortgage insurance. It goes into a mortgage pool, and if you default on the loan, that's what keeps the banks whole, and that's what incentivizes them to offer FHA products.
Awesome. And thank you
So
so much for that. And I know in the future what we'll do is we'll have some videos
there's
specifically on that because
there's pros and cons. There's pros and cons to both of them. So
yeah, awesome. All right. Well, thanks so much, Jace. I appreciate that clarification. You guys look at this. The loan limits created an amazing opportunity coming into this next year. And those that are thinking about selling, what does this mean? What this means is that there are going to be a lot more buyers that can afford more, which is great. And I'm going to speak to that now. Jace, was there anything else you wanted to mention as of right now?
I appreciate you.
Yeah.
And just for any listeners out there, not every finance and mortgage professional and real estate professional is built the same. I could speak for Josiah and myself that we like to develop more of a personal relationship with our clients. We're not, we do our best to feed our families, but we're not this high volume producer. And so we're gonna be available at the 9 p.m.s. We're gonna be available to answer questions on the weekends. We're gonna be available to our clients because it's more than just a number to us. So I guess
Absolutely.
I guess that's all.
Well, I appreciate that, Jace. Thank you. Listen, guys, I just want to share this a little bit with you. And we're specifically kind of talking on original price, sales price, and where that is and what homes have sold at. One of the things that we were talking about earlier is in the market a year ago, 2 years ago, even 18 months ago, we were looking at homes listed at a specific sales price selling for 10% over 15, 12, 13, 20% over in some cases in certain markets. I mean, if the house was priced really low, I mean, I saw one, I remember at the height of the craziness that was going on, or there was a house priced at 500, sold for 680. And that's no joke. You know what I mean? And it was clearly, it was an underpriced home, and the agent looked really, really good. I couldn't imagine being that agent though, with those 40, 50 offers and trying to sift through all that info. But that's why we have all this with you guys, or right in front of you guys right now. And I wanted to just share this with you. This is going back a year, and we're looking at 2021. And I want to just show you what was happening to the median percent of the original price sold. How much was it sold? If it was listed at a specific price, was it sold above or below that price? And as you can see, the trajectory, you guys, it is down on a downward scale coming into this fourth quarter this year. I have highlighted specifically Ranch Cucamonga, Fontana, and Upland. And I just want to share this with you guys. As of 2021, in February last year, homes were selling for about 100%, in Rancho, 100.9. The entire MLS as a whole, the average in California was selling for about 101 of the list price. In Fontana, 102.6. Okay. And we come up at the height in June of 2021 last year, you had 106.2 in Fontana, 6.2% over list price, 105% in Rancho, Upland 103.6. You guys, and we saw this tail off just a little bit as it came into the end of the year, which is average. Jace, obviously, we understand certain times of the year people like to move out during the summer when the kids are out of school, and coming into the holiday season, a lot of people like to be at home. And the market is, even though we get busy for sure, I mean, my fourth quarter every year is always one of my busiest ones. It's funny how the overall market does see a downturn towards the end of the year. But January, at the beginning of this year, what we saw was an increase, or we saw it kind of, be at, if it was at list price, it was sold at list price. As you can see, 100%, 102.7 in Fontana. Lots of attention to Fontana. And the reason why is because there were a ton of new builders there. You had KB Homes, you had Lennar, you had Taylor Morrison, and they were able to really do their best to keep up with the demand and moving into that area. And they were selling their homes like hotcakes. I don't know how many mornings I stood out there with new releases in a line of 150 to 300 people with my buyers, just trying to get to the front of the line and be in the drawing for one of the new homes that was being released. So anyways, what we saw in here at the height of our market this year, which was between March and May, okay, we saw homes selling for 105%, back up to that top where we saw last year, right? 105, 105.1, 104.8, 105. And then what do we see? As you can watch this come down today, up to date right now here in November 2022, you guys, overall, the entire MLS in California is 96.8%. That is, 3.2% lower than list price. That coupled with the increase in affordability with the numbers that Jace just shared with us now. Guys, what does this mean? This means that homes are selling for lower than list price, and you can afford more home. So over the next 3 to 6 months, this is really why we're putting this video together, is really to show the evidence and share with you that right now we're in a market where you can negotiate terms, you can create opportunities to really get the best deal possible, buy into the neighborhoods that you couldn't afford last year because now affordability has increased. And with those programs that Jace mentioned earlier, the 2-1 buy down, the 3-2-1 buy down, and save money in the short term with a lower monthly payment and a lot more affordability. And I just wanted to share with you guys with something in total sales price. Okay, what we've seen the market from January 2021, even though we've had these corrections, even though you saw the over list price, you saw what the market had done even leading into November this year, your sales price as a whole, and this is the long game, it is still in an upward trajectory. Okay, and this is just to speak, you guys, hey, listen, getting into a home today means that if you're there for the next 4 to 7 years, and so I know some metrics say 7 to 10 is the new norm, Jason, I'm sure you can speak to that, but what does that mean? That means that your property is going to increase in value regardless. Historically speaking, that's going to happen. 2, if you rent, you're paying 100% interest because you're always paying a mortgage. It might not be your own, but it is definitely someone else's. And so you're putting that equity back into your own pocket. And as you can see, regardless of the ups and downs and the fluctuation in the market, home prices are still higher than they were last year because the market will continue to increase over the course of time. Let's look one more last thing in what we're looking at right now, guys. That craziness that was happening that we spoke to this time last year, 7 days on market, 11 days on market. Jace, you and I both, how many times were we running, pre-approvals and writing, countless offers, just trying to get in, to the story you spoke about earlier, the agent on Monday morning, dude, I've got 1,500 phone calls. What do you want? You know what I mean? It's like, that was what it was like, as a listing agent. and having my listing sitting there being like, hey guys, listen, the cutoff is Monday at 5 p.m. and having just, I mean, having to hire somebody to help me just run through my emails and organize all the offers.
Yeah,
And
the cutoff was Monday at 5 p.m. and they had an offer accepted by Monday at 6 p.m.
yeah, exactly. It got low as 6 days here. And I mean, there was a point in 2020 or early 2021 where it was at 4 days. I knew that. I remember reading that as the national or yeah, specifically to Southern California. And now where are we? Right? 24 is the average in Ranch Cucamonga, specifically what we have going on right now. And I'll share this with you guys. In Rancho, as of the last 5 days, what we have, you guys, active listings, there's 216 opportunities. 216 homes that are for sale today in Ranch Cucamonga. 15 new listings this past week. Okay. And the median days on market is 53. Right? What does that mean? That means that there's more inventory. Yes, on the grand scheme of things, it's still not enough inventory for all those buyers that are out there, right? But there's more inventory. There are new listings hitting the market still because people still need to sell regardless if Christmas is 3 weeks away. And houses are sitting on the market for longer. What does that mean? That means either one of two things. It's either the condition of the property or the house is priced wrong. And right now, what we're seeing in this market is if a house is on the market for X amount of time, it's because buyers are saying, you know what? I don't think that house is worth that much. And that's where we're at as buyers today. And that's really what Jason and our goal was today, to convey to you guys that right now, if you're if you're even thinking about it over the next 3 to 6 months, it's definitely a conversation we'd love to have with you. Jace, was there anything else that you wanted to share today? Any kind of other information or insight?
Man, you hit it, dude. You
Yeah.
you hit it. Obviously every scenario is different. Everyone's scenario is different, and everyone's situation and scenario is going to bring different questions and different answers for those questions. So I'm always available, and I can contest to Josiah always being available to our network and our friends and family and our clients and our future clients. So if there's something that you have questions about, give us a call. Like we'll make it very easy for you. We're not into like a high pressure sales and peep type of person. We're very down to earth. And I know, like I had said before, like my goal is to feed my family, but it's not going to come at the sacrifice of a service. I understand that I am a servant to our clients. So if I walk away from a conversation knowing that I've given you the tools to help make a better educated decision for you and your family, I win. So, and I know Josiah is the exact same way. So
I appreciate that. And where can people find you on social?
It's the loan guy _ J Stray. It's JACEDREY. You could search me. I'm working on getting my website going. But either way, super easy to find. The loan guy _ J Stray, JACEDREY. I'm pretty active on there. So if you send me a DM, or I do have like my link tree on there, you could get a hold of me. Call me. I pride myself on being available. So, and if I don't answer for whatever reason, I'll get back to you real quick.
And of course, we'll have all our contact information in the description below. And, we appreciate your like and subscribe if you guys would like more of these videos, or maybe you have some specific questions. You have some specific questions to your neighborhood, the market. This message today has resonated with you, or you have, some kind of critique, or, we welcome the critique, we welcome the criticism, and we look forward to providing more information moving forward and in the future, especially moving into 2023. Hey, listen, like I said at the very beginning of this, today is the first day of us doing this together. Hey, we're the kind of people that we commit to something and we just do it, man. We make it happen. To speak to what Jay said, hey, listen, it's all about communication. And one of the things that differ our team from just anybody else that's out there is, listen, we meet you where you're at in the journey. It's not about getting you into a home like next week, right? No, it's hey, this might not make sense for you, right? But what are we going to do to get you to a point where not only do you feel empowered, you're educated, and you feel confident making a decision moving forward? Because that ultimately is what's going to give us the opportunity to not only be in business with you for this particular transaction, but for all the transactions for the rest of your life. Because we're in the legacy business, and we have the goal of doing business with you, your loved ones, and we benefit from that. Our bloodline comes from referrals, and that's what we want to do. What we want to do is create a product and an experience that brings you back, and that brings creates the greatest fan in our clients and in who you are, or as our client. And a lot of times, and Jace, I know you're the same way, man, but our clients become our friends. They become part of the family. And I know with my 3 kids, at some point during a transaction, you'll probably meet one of them, if not all 3. So hey, that's what you get when you work with me and Jace and our team. And I just want to thank you guys so much. For those of you that stuck through to the end of the video today, like I said earlier, we will be doing this. More than likely, it'll be a video a week, and we're going to be talking about market updates specifically, but we'll have some really great topics. We're going to dive a little bit deeper into FHA versus conventional. We're going to dive in deeper into to what's going on, what's projected into this next quarter 2, and even into quarter 3 and quarter 4. There is so much busyness out there. There's so much information. And hey, I know I get paralyzed by analysis sometimes. And so we really want to filter through that and provide a lot of value to you guys. And we just appreciate you listening today. You can find me on Instagram at Josiah Sukso Realtor. I look forward to connecting with you guys. Thank you so much for watching our video today. And hey, we're here to serve, and we look forward to serving you if we can. All right. Have a great one.
Bye.